Warren Buffett has more than a fifth of his Berkshire portfolio in one single stock. What's even more surprising though is that it's in an industry he's always hated. By the end of this video, you'll know exactly what Buffett sees in this company and whether you should follow him in the stock. We're talking Warren Buffett stock picking today on Let's Talk Money. Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in our community. Thank you for taking a part of your day to be with us. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. The Berkshire Hathaway equity portfolio includes just 42 companies for a total of $196 billion, and it's surprisingly concentrated in just 3 industries. Banking makes up more than 29% of the portfolio, followed by consumer staples, which is 18%, and credit and financial services at about 12% of the total portfolio. Now, these are all normal investing targets for Buffett. He likes the consistency of cash flows, and those sectors don't change quickly. But he's also got $45 billion in one technology company, a sector in which he's rarely invested and as often says he doesn't like the fact that innovation can make great companies obsolete so quickly. Now that big bet on tech is actually $45 billion in a single company. That's more than a fifth of the entire portfolio in just one single stock. Now in this video we'll look at this investment, why Buffett thinks it could be the stock of the decade, and why I think he might actually be wrong on this one. Now Warren Buffett took the lead of the Berkshire Hathaway holding company in 1965 and has rewarded investors ever since. Returns on shares have climbed 20% annually over the last 38 years. That's more than double the return of the broader market. Now that means instant market buzz anytime the company files its Form 13F. That's the disclosure all large money managers have to file every 3 months. That look into Buffett's investment is what we're using for this video series on the Oracle of Omaha's stocks. We're looking at Buffett's biggest investments, his favorite industries, and even his worst investment. We'll look at the stocks Buffett believes in, why he loves them so much, and how you can use all this to find your own investments. Subscribe and click on the bell icon to get notified when the rest of the series goes live. I'll also be putting a link in the video description below to a special playlist with all of those videos. Now that large tech investment is of course Apple, ticker symbol AAPL, to which Buffett added 74 million shares in early 2018 for a total worth about $44.8 billion. Now, Buffett has said he doesn't believe in diversification, instead choosing to pick individual investments, and he's definitely proving that here. Now, the amount he has invested in Apple isn't the surprising part. It's the fact that he's investing in tech at all after his IBM investment only broke even after 6 years. So Buffett must have some pretty good reasons for wanting to own more than 5% of the iPhone giant. Let's first look at what Buffett has said he sees in Apple, and then we'll look at some of the fundamentals for new investors. First, Apple has a ginormous amount of cash, more than $267 billion sitting on the balance sheet last quarter. We know that Buffett loves cash, usually cash flow from mature companies, but that Apple cash gives it a lot of options and flexibility. Buffett has said he wants the company to devote more of that cash to buying back shares, and Apple has said it will spend $100 billion doing just that. Even as a tech company that constantly needs to spend on R&D and innovation, Apple is a cash flow machine. This is the statement of cash flows, my favorite financial statement and one that should be your new best friend if you're going to be picking stocks. Apple generated nearly $66 billion in operational cash flow last year and spent just under $64 billion for growing the business, aka investing cash flow and in financing. It generated over $50 billion in free cash flow, which is the operational cash flow minus the investments it made to keep the company heading in the right direction. Now, besides his affinity for cash-generating businesses, Buffett is a value investor at heart. Now, he's made his best deals during bear markets when he could get preferred shares with huge dividends and convertible into common stock. Now, Apple checked this box when Berkshire first added shares in early 2016. Shares had fallen about 25% from the 2015 high on worries about the product refresh cycle, something that happens a lot with Apple, and we'll talk more about this later in the video. So Buffett was getting the shares at a discount and what turned out to be a great value. Finally, even though Apple is a tech company at its heart, it's also a consumer goods company, right? Apple and Samsung have carved out about 20% of the global smartphone space each, more than double the market share for any other competitor. Now, besides those things in your pocket that used to be for calling people, Apple has its other products like the iPad and Macs, as well as services like iTunes. Even if you're not an Apple person, you probably have at least one product or service. So Apple checks a lot of those boxes for Buffett, and he's done great with the investment. But let's look a little closer at the fundamentals, and I'll show you why you might want to wait a little bit to follow the Oracle into this bet. First, the most obvious objection is just the price. I'm a little surprised that Buffett jumped in again in 2018 after shares of Apple have almost doubled his initial price. The stock is now trading for over 17 times the company's earnings over the last year. That's over the long-term average of around 14 times, and over the low of around 10 times earnings it often hits when investors start worrying about that product life cycle. In fact, I invested in Apple in 2013, another time when investors sold out and the shares hit that rock bottom valuation of between 10 and 12 times earnings. Of course, investor enthusiasm for Apple has always been about that product refresh cycle. That's when it unveils new upgrades to the iPhone and other products. Apple has to manage this carefully because consumers usually get help paying for their phones with 2-year contracts, so they aren't going to want to update every single year. Now, Apple manages this by having different tiers of its phones, different models, and updating them in different years. Those big sell-offs in 2013 and 2016 were both about this product refresh cycle. Apple had already rolled out the major upgrades in its biggest sellers, and investors were worried that sales would be weak in the near term for lack of new exciting updates. And we're starting to see some signs of this again. Last year was the 10th anniversary of the iPhone, so Apple went big with the iPhone X. But there just doesn't seem to be much enthusiasm or the rumors there usually are for the September event this year. That's when the company typically announces its biggest upgrades. And customers might be getting a little tired as well. Tokyo's Nikkei newspaper reported in June that Apple was reducing iPhone component production by 20% in a sign of slowing demand for phones this year. The problem here isn't that Apple won't continue to make a lot of money. It will. The problem is that enthusiasm for the products comes in waves, and we're already at the top of one of those waves. If you're thinking about investing in Apple, the worst you can do is put all your investment in at once right now. Now, I would wait a few months at least for a better price, but if you have to do something right now, try legging into your investment with just a third of what you planned on investing. You can invest the rest in maybe 2 buys over the next year to take advantage of better prices if they come along. Now, a longer-term threat to Apple is competition in that smartphone space. Chinese producer Xiaomi doubled its shipments in 2017 to 92 million smartphones and grew faster than Apple, Samsung, and Huawei combined. Global market share jumped to 6% from just under 4% in 2016, and the company went public recently, so it's got a lot of cash now that it can use for more growth. Other rivals like Oppo and Huawei have also increased their market share, while Apple has really fought to hold its share steady. Now, Apple sells to a higher price part of the market, and its brand helps it retain that market share. But there will be a point where investors have to start worrying about that slow bleed of customers to some of these other competitors. Obviously, Warren Buffett's 2016 investment in Apple was a great one, but I'm not so sure about his purchase of more shares in 2018. As a very long-term investor, he'll still make money even if the price comes down for a while, but I think new investors will have a better opportunity if they wait 6 months or even a year. Click on the link in the video description below to watch all the videos in the Warren Buffett playlist, and don't forget to subscribe to the channel. We're here Mondays and Wednesdays with the best videos on beating debt, making more money, and just making your money work for you. If you've got a question about money, just scroll down and ask it in the comments, and I'll make sure to answer it in a future video.